Can you retire and live off the dividends forever? How much capital do you need in your savings account to achieve this highly desired goal? I did the math based on a popular high-yield ETF QYLD, as well as another one SCHD, and the answers to these questions may surprise you. First, QYLD is a covered call ETF. It invests in Nasdaq 100 index stocks and sells call options on this index. You probably know that this ETF has a higher yield compared to your typical dividend fund. We see that its yield stands at about 12%. Compare this to a typical dividend ETF such as SCHD with a yield of roughly 3.5%. QYLD's yield is over 3 times bigger. When we look at stats from the Federal Reserve in 2022, here's what we see. Almost 50% of American households have no savings at all in their pension plans. And those who do, there's a large proportion of people with insufficient savings. So it becomes understandable why covered call funds are so popular among retirees. With high yields, these funds seemingly promise households to live off the dividends on a smaller savings account. For instance, if someone wants to live off the dividends from SCHD, here's how much one needs in savings. Suppose a household needs $80,000 a year, which is a median income in the US. I assume 100% reliance on dividend income. Of course, if you have other income sources such as Social Security, you may need less than that. With SCHD's yield of 3.5%, one needs $2.2 million in savings to live off dividends alone. I came up with this number by taking $80,000 and dividing it by the yield of 3.5%. But covered call funds such as QYLD allow retirees to live off dividends at a much smaller savings balance. With 12% yield, I would need roughly $670,000 in savings. That is almost 3 times less compared to SCHD. So it seems that QYLD is a clear winner and SCHD is inferior to QYLD, right? Well, unfortunately, the answer to this question is kind of complicated. In this video, I want to show you that you cannot rely on this 12% yield from QYLD to live off the dividends. On top of that, you may not be able to keep all your distributions. You may have to reinvest at least part of them. While I make these calculations based on QYLD, this logic may apply to other covered called ETFs. Most of the data you see here will be coming from Seeking Alpha. I partner up with Seeking Alpha and there are affiliate links down below. It's a great tool to research ETFs and stocks, so check it out. First, we have 10 years of distributions and stock price data from QYLD. Based on this, we can infer what can happen to someone who went with QYLD for 10 years in retirement. So let's imagine someone retiring and needing $80,000 a year today. For now, I will ignore the tax side of things, but we'll come back to it later. Suppose that QYLD is a new fund that got out in 2024. Let's use its distribution and price history as if it starts today. You're thinking of putting all your funds into QYLD to live off that promised 12% yield. Actually, back in 2014, the promised yield was a bit lower at roughly 10%. Based on this, the required savings account is $775,000. Based on the stock price of $25, you would probably buy about 31,000 shares of QYLD. We keep this amount of shares constant in our example. The first year is great. You get precisely $80,000 from QYLD in distributions. But for the next several years, we have a problem. QYLD distributions start fluctuating. Your second year, you get $68,000. So you're short on $12,000. Your third and fourth anniversaries are even worse. The income declines to $55,000. By the fourth year, you're short on over $50,000 on a cumulative basis. From year 5 through year 8, things get a bit better as distributions recover. Still, you have a slight deficit. However, after year 8, distributions begin to decline again. In year 10 and 11, you are again short on funds of almost $60,000 and $14,000 respectively. So right off the bat, we see that retiring on QYLD income is tough. And here, of course, I assume that the historical performance will repeat itself or at least rhyme in the future. Anyway, Fluctuating distributions is a big problem. As someone in retirement, the goal is to have a stable and growing income. Otherwise, budgeting and paying bills each month turns into a nightmare. Based on what I've seen and researched, this could be a common problem among covered call funds. And there are two main reasons behind it. The first one has to do with volatility. Volatility is QYLD's friend. Every time a volatility of an index spikes, the options on this index and its prices also spike, leading to higher income for QYLD's investors. Conversely, when the index goes sideways or its volatility is down, QYLD is able to distribute much less to its investors. The second problem has to do with NAV erosion. You may have heard this term before. If not, here's what to know. NAV, or net asset value, is the fund's assets minus its liabilities. And NAV of a fund can change for many reasons, including the creation or redemption of its shares. But NAV per share can change only due to net investment gains or losses or distributions. Also, NAV per share and the stock price of a fund can deviate here and there, but long term they should be approximately equal to each other. So NAV erosion is just a way of saying that the fund's stock price goes down. NAV erosion is a big problem for many covered call funds. It can lead to smaller amounts of capital that fund managers can deploy to earn capital gains and income. When that happens, distributions per share are next on a chopping block. For instance, we see that QYLD's price declined from $25 to $18 since inception. And this is despite the fact that Nasdaq 100 is up by a very large percent. At the same time, we see that as NAV erosion took hold, QYLD's distributions stagnated or even went down. NAV erosion likely happened due to how covered call funds like QYLD are structured. Almost all these funds are regulated investment companies. By law, they must distribute at least 90% of their income to investors. Because QYLD makes distributions non-stop, inadvertently some become a return of capital. This happens when a fund distributes more than it earns. Return of capital distributions do not trigger taxes right away. Instead, they lower your investment cost basis. So in a sense, it's like a tax-deferred gain. Later, when you sell your QYLD shares, you will pay a higher tax on your capital gain based on a lower investment cost basis. So return of capital distributions, it's like a fund is giving you your money back. Like you give them $10 and then they start giving you $1 at a time back and back. If we look at QYLD, we see significant NAV erosion in 2022. Investigating further, we see that over 90% of distributions were return of capital. Nasdaq 100 performance in 2022 was terrible. It went down by more than 30% that year. QYLD also went down with it and racked up large investment losses. But because the fund continued distributing funds from call options, NAV erosion occurred. While Nasdaq 100 is up since 2022 by a lot, QYLD is still struggling to recover. This will be generally true for QYLD going forward. Anytime there is a large drawdown in Nasdaq, NAV erosion will get bigger for QYLD. What's worse is that we recently had a high inflationary episode, and we're not sure if this will repeat itself. But let me show you the extent of the reduction in your purchasing power due to inflation. Let's assume that the average inflation rate over those 11 years was roughly 2.5%. In other words, your budgeted amount of $80,000 must go up by at least 2.5% each year. In fact, by the 11th year, you need $102,000 just to keep up with rising prices. This way, your shortfall from QYLD's income gets much bigger. By the 11th year, your nominal shortfall was almost $15,000 as we saw earlier. But after taking inflation into account, you must have had $102,000.5 In dividend income, your actual QYLD's distributions were about $65,000, so you were short on $37,000. So we see that a retiree is already struggling with his budget due to fluctuating QYLD distributions, which are declining due to NAV erosion. On top of that, his purchasing power and real income is going down due to high inflation. That's a big problem and a lousy outcome for QYLD. Is there anything that we can do to counter this problem? Well, there are several ways, but one of them is to either have higher initial capital invested in QYLD or reinvest at least part of your distributions back into QYLD, say, or some other fund. And this way you will get to keep much less of your distributions. And let's see by how much. What I do next is a very simplistic and in no way accurate method to estimate this, but all I do is vary the percent that needs to be reinvested to see if the shortfall in real terms goes away. Here we see the shortfall with 20% reinvestment assumption. The goal is to have deficit as close to zero as possible. It seems that 40 to 50% reinvestment rate is the way to go. The initial capital required went up from $800,000 before to roughly $1.3 million though. But there are a few caveats here. First off, there's a time of money concept at play here. In years of excess money, you can take this money and invest it into something that can earn interest and offset your years of deficit. Also, this example is only for 11 years. What if QYLD's NAV erosion gets worse down the road? Well, in that case, you may have to reinvest potentially even more than 40 or 50% of your distributions. How much more? Well, it's hard to say. It depends on QYLD's NAV erosion, index performance and volatility, as well as inflation rates. So as you see, we started with a very simplistic scenario. We came up with about $800,000 in initial capital. But later we had to contend with NAV erosion and inflation rates, which required us to up our initial capital to $1.3 million. And I must stress that this is in no way a precise example. There are many assumptions here. The goal here was to show the scale of dilemma for covered called funds. There are of course other funds with lower yields. Earlier I showed you an example of SCHD, and we saw that you may need higher initial capital contribution or savings balance to live off dividends. But investing in SCHD comes with several distinct advantages. First off, most of QYLD's distributions are taxed as ordinary income most of the time. Of course, return of capital distributions are an exception. Conversely, SCHD and similar dividend ETFs are taxed at preferentially lower tax rates. If you're married filing jointly with income below $94,000, your tax rate on qualified dividends is 0 in 2024. If all your income is from QYLD's distributions, you may have to pay roughly 7% in taxes on your $80,000 income. Of course, the average tax rate will depend on your personal situation. Either way, you may have to account for this tax difference in your estimations. But the best part of ETFs like SCHD is that their dividends per share tend to show consistent long-term growth. For instance, here are the dividend distributions from SCHD. They are steady and mostly growing. This is exactly what a retiree wants to see in a dividend fund. Since 2014, SCHD's dividends per share grew by 11% on average. Compare this to stagnant or even declining distributions from QYLD. With 11% growth, not only can you beat inflation, but potentially have excess funds over time on your hands. On top of that, SCHD's stock price appreciated in the meantime by almost 100%. On a total return basis, SCHD provided a much better deal for retirees over the last 10 years compared to QYLD. Here I am using the total returns chart from Seeking Alpha. SCHD beat QYLD by more than 100%. That's a lot. One thing of caution is that these numbers here assume reinvestment of dividends. If we look at total returns without reinvestment, SCHD still
beats QYLD comfortably by over 2 times. That's a staggering difference.
So in conclusion, we see that QYLD is unlikely to be a robust investment for retirement. And this is especially true if you want to live off dividends alone. And if you want to counter its negatives of QYLD, you may have to have a higher initial investment capital in your savings account, as much as $1.5 million for a required annual income of $80,000. And even with that, the returns of QYLD may not be as good as for other dividend ETFs. Conversely, SCHD and similar dividend ETFs may require higher balance on your savings account, but long-term they may be a much better option in retirement, in my opinion.
Overall, it's understandable why covered call funds are so popular. We saw earlier that there are many people with little in their savings accounts. With high yields, QYLD and similar funds promise a seemingly comfortable retirement. But it's very likely not a good option in my opinion. It is a real dilemma for many retirees, and I highly sympathize with this issue.
I hope this video gave you a glimmer of insight into retiring and living off dividends. It's a great concept, but it may require much larger capital commitment than most think. As for the calculation and spreadsheet I used in this video, it is available on my Patreon page. If you would like to support my work and gain access to my exclusive content, check out my Patreon page linked down below. As always, thank you so much for watching. I hope I was of service to you. Please like, subscribe and share this video if you think it can help someone nearing his retirement. All the best, and I'll see you next time.